Newman of Cirrus Research. The latest issue of the Signals Report is just out. It is our market outlook, and the title of it is Market Crowding Spotlights Changing of the Guard in 24. Underneath this current environment, we think there are two things at play. One, there's a fundamental support for equities underway, and at the same time, potentially some self-correcting effects from the 23 effects. This first chart really underscores some of the fundamental underpinnings of equity valuations. What it's showing is that the profit cycle has been slowing for the last couple of years, thanks to what the Fed's done. Really, some of this is the post-pandemic fallout as well. But importantly, what we're noticing is that the forward estimates are starting to stabilize. In other words, if you go back a year ago, we were seeing a ton of estimate cuts. Today, it's like break even. So there's enough, almost like 4 out of 10 estimates are getting raised again. So we think that's a hint that the top line growth is about to reverse course. This is generally a constructive thing for equity valuations. Another key point here, and this is probably maybe more important about a forecast for earnings growth, credit. Credit access is actually quite strong and has become just about as favorable as they were just 2 years ago before the Fed started tightening. It is shocking to us that except for the sort of small banking crisis back in early 23, the credit markets have rallied back to levels that was almost really pre-Fed tightening. And so we think this is, by the way, occurring globally. So I do think that this kind of credit backdrop allows for earnings growth to really propel forward, potentially reversing the course of the last couple of years. So what's wrong with the story? And at the end of the day, it has to do with really the fallout and really the makings of the Nifty 7 effect of 23. What we've seen is this dramatic run up in megatech stocks. Our crowding measure, and this is really a proxy for it's really flagging tactical risks in the equity system or a break in leadership. This reading is now flashing red. It is suggesting that these leadership stocks have really earned their way into their prices. However, the prices has escalated well beyond those normalized levels. So if we're right, and you do get a potential break in leadership, it's still constructive really for equities. However, this could have a significant impact on leadership. Factor-wise, think about trending factors really breaking down. Importantly, some of the fundamentals are also shifting. What we've been noting for the last couple of years is that industrial spending is continuing to accelerate. Technology spending has sort of flattened out. It's still very good, but it's not accelerating. And that is something that I think we're going to have to reconcile in 24. So how do we put this together? In terms of the growth portfolios, we're migrating away from a quality bias. As you know, we've been in this quality bias for the last couple of years. Higher quality stocks now are stupid expensive as well. And if we're right about the profit cycle reversing course, the GARP model has more of a valuation emphasis. We think that will be important. The aggressive growth model has a ton of trending emphasis on it, worked well in 23, unlikely to work well in 24. And on the value side, something similar. We're in this relative value bin. We're going to sort of shy away a little bit from the quality value area and then move more into some cyclicals, namely industrials. So take a look at the full report. And as always, we look forward to getting your questions. Thank you.